Hey guys, it's Julius and welcome back to another video. So if you have ever wondered or at any time ever asked yourself, should I invest in the stock market? You're not alone. Investing in the stock market can be intimidating, but if you want to grow your wealth, investing is a must. Now, stock investing is not as complicated or difficult as you might think. It's not just wealthy bankers who invest. Millions of regular people like you and me invest too. But not enough of us, actually over half of Americans, say they are not participating in the stock market. Now, people have various reasons for being afraid of the stock investing, and while all of them are legitimate, not all of them are rational. Now, most of us don't have the kind of salary that will make us rich or even give us enough money to retire comfortably. And most of us would like to retire someday, and even if you don't, your health may not allow you to continue working right up to the end. Now, most of us don't have wealthy parents who are going to leave us a vast inheritance. So how will we be able to afford to retire? The answer is coming up. So the answer is simple: investing. The reason most of us have a fear of investing is that we don't understand how the stock market works, and we don't actually take time to try to learn how it does, because we think it's too complicated for a layperson to understand. And that is not true. I could sit here all day and talk about how the stock market works, and plenty of people have, but yet for most of us, it's just not that interesting of a topic. So in this video, I'm going to try and break down how the stock market works, so you can stop wondering whether you should invest in the stock market and just go ahead and do it. Now, this is because what's going to happen when you don't invest should scare you more than the thought of investing. Now, first, what is the stock market? So when you first see the term stock market, it actually means one of the big stock market indexes like the S&P 500 or the Dow Jones Industrial Average. Now, tracking all stocks is tough, so these indexes represent a segment of the stock market, and how they perform is seen as representative of the whole market. Now, when you hear that the stock market is up or down, it typically means that the stock market indexes are up and down. They have either gained value or lost value as a whole. Now, when me and you, if you're already investing in the stock market, we want to eventually sell it and make money based on these ups and downs in prices. So when we do that, we pay less for stock that we can later sell for more. How the stock market works? Now, public companies use the stock market to raise money, and their stock price is an indicator of how confident or uncertain investors are about the company. Now, the prices of a share of a stock represents what buyers and sellers consider its value to be. So here, supply and demand come into play as well. When more people are trying to sell a stock than more are willing to buy it, the price drops. So if the prices continue to drop on all stocks, it's known as a stock market crash. So take for instance what just happened at the beginning of the year. The pandemic caused the most recent market crash. And if these price drops continue, we can enter what is known as a bear market. A bear market is when a market experiences a prolonged price decline. It describes a condition in which securities prices fall 20% or more. Now, the opposite of a bear market is the bull market. A bull market occurs when stock prices rise for an extended period. So the longest bull market occurred between 1990 and 2000. This is when we saw stock prices rise over 400%, and during the period as measured by the S&P 500. Now, ideally, this is when you can sell off your stocks and make bank, but most of us don't do it the other way around, where we sell during crash and lose money. Now, when it comes to crashes, on the other hand, even if you don't follow the stock market at all, you are probably aware of some of the major stock market crashes throughout history. And that awareness may be part of what is putting you off buying stocks. But should it? History tells us no. There has been no shortage of US stock market crashes, and yet the market continues to go up over the long term. Now let's take, for example, right, the crash of 1929, known by many as Black Monday. Now the market fell by 12.8%. It took 12 years for the economy to recover from this Great Depression. Then there is a crash of 1987, known as the second Black Monday. Now by the end of this crash, the stock market had lost 23% of its value, and people had begun to talk about implementing a circuit breaker into computer trading platforms that would suspend trading on high-risk trading days. And if you remember, this was implied a few times during the pandemic-induced panic. Now with this crash, things did not stabilize for almost 12 years. Then we had the Great Recession of 2008. Now the housing bubble burst in 2008 and took the economy with it. Here we saw the government providing massive bailouts across multiple industries, something we saw again during the pandemic. And by late 2009, the economy started to come back. Now the reason I'm giving you all this information is to show you that history doesn't lie. Now investing in the stock market is about managing risk. You see, investing in the stock market or anything else is not without risk. There are things that you can't control, but there are still plenty of ways to minimize the risk of investing. Now you need to look at how long it will be before you need the money you're investing. For instance, if you need the money for short term, that's 5 years or less, for buying a home, or medium term, 5 years to 10 years for maybe your child's tuition, and then for long term, that's over 10 years for retirement. Now the rule of thumb is that the shorter your time horizon, the safer the investment should be. An online saving account is an example of a safe short-term investment. And the reason I say online is because they typically pay slightly higher interest rate than your savings account. Now the reason I invest in the stock market is considered a risky investment in comparison to other kinds of investment is because of the ups and downs the market experiences. But by investing long term, as you do when you invest for retirement or another goal that is at least a decade off, is how you beat the ups and downs in the stock market. Because that long time horizon gives your money the chance to rise out market fluctuations. Now some years you're going to win and some years you're going to lose, but over a long time period you're going to win. Now you may think your money is nice and safe sitting in your checking or savings account, but it isn't, because the amount of interest those accounts pay is smaller than the average rate of inflation. Your money is losing value sitting in these accounts. Now you may make good salary and save lots of money, but when that money is earning no interest and being eaten away by inflation, your saving won't be enough to see you through your retirement. In fact, you'll be at considerable risk of outliving your money. Now you need to start investing, take the calculated risk and grow your wealth. Now I hope this piece of information can change your mind about investing. If you like the content in this video, hit the like button, consider subscribing to join the journey. See you in my next video.